Thank you very much for that, Luke. A really interesting insight into thoughts of government and how the economy runs as a whole. As Luke said, I'm going to take you through personal tax matters relating to businesses and private individuals. Looking forward, we were really surprised in the announcement by the Chancellor yesterday of the decision to raise the personal allowance to £12,500, coupled with a £37,500 basic rate band. Real surprising that he said he was going to meet the previous election pledge and achieve that by 2021, but the rabbit he brought out of the hat was actually he was going to bring that forward a year early. So from 5th of April next year, we're going to see effectively a £50,000 band of income where you'll pay tax at only basic rate. If you've got a personal allowance and income is over 100,000, watch the taper that I'll talk about later. Equally for savers, no changes to the personal savings allowance, and also dividend allowance now sitting at a £2,000 level. The other aspect, as I spoke about, is the basic rate increasing to 37,500, so a £3,000 increase on that band compared to the current year. We still see tax rates staying exactly as they are, 40% up to 150,000, and then 45% thereafter. So no changes to the effective tax rates. One of the things we've seen over the last few years is dividends, particularly clients who run their own family business, now subject to much higher tax rates. No changes to those, but those tax rates now make a difference to how you might extract the money out of your business, particularly if you've got varying ways that you can extract money, which I'll cover on later. Key aspects are that dividends now in the higher rate band are taxed at 32.5%, and 38.1% if you're an additional rate taxpayer with income over 150,000. You'll see at the bottom there, dividend allowance was previously 5,000, but in the current year the government reduced that to 2. What we're seeing is allowances being introduced and then swiftly withdrawn by the government, making the tax system incredibly complex. The other thing I want to talk about is some of the ghostly, spooky issues we come up in tax that are often hidden in the legislation. The 50,000 is now quite a key number for us in tax in terms of moving into the higher rate band, but many people aren't aware there are further tax issues that can arise at that income level. For example, if you have children, you'll start to lose your child benefit at that level. You'll see on the screen there, I've got an example of somebody who's a sole trader. If their income up to 50,000 is taxed at an effective rate of 29%, being the basic rate tax and national insurance, as soon as they move through that 50,000 barrier, their effective tax rate with 2 children will move up to almost 58%, effectively a doubling of income in that £10,000 band. So a really important planning point. That might be both for you as business owners or equally in terms of how you reward your employees. The other fairly spooky aspect is the £100,000 barrier. Again, quite a high level of income, but many people are unaware that they start to lose their personal allowance at that level. With a £12,500 personal allowance, it will effectively be lost when the income totals 125,000. So what we're now seeing is a band of income from 100 to 125,000 taxed at an effective rate of 62.5%. That's the 40% normal high rate tax, 2% national insurance, and then an additional 20% through the loss of the personal allowance. Again, effectively a 50% increase in the marginal tax rate when you tip through that barrier. There are other taxes that are also affected at 100,000 in that there is some child tax credits that you can get through childcare. As soon as your income tips over to 100,000, you lose that ability completely. So for a couple, they could be claiming £4,000 tax credits towards their childcare, which would immediately be lost as soon as their income hits 101,000. So at 101,000, we could see an effective 4,000% tax rate. Moving on, just want to talk about how those numbers haven't changed. The government are very clever at stealthily not raising allowances and thresholds. So the £50,000 limit when that came in, had it been increased by CPI, would now be 54,000. If we look at that another way, somebody earning 45, 46,000 when this allowance came in, or this band came in, they would now be falling into the £50,000 point at which they start losing their child benefit just through general inflationary increases in salary. Equally at the £100,000 point, We're now almost 10 years into that, and had that been increased by inflation, that would now stand at 116,000. Again, if you look at an alternative way, an employee on just over 85,000 when this ban came in, if they got inflationary increases, they would now be suffering the loss of additional tax at 100,000. A formal fiscal drag that the government are using to pull more and more people into these high tax rates. We talk as a business to many people who run their own company, and they want to seek ways of extracting money as tax efficiently as possible. Those rates and allowances allow us to do that. And on the screen there, you'll see a way in which you could extract as a family £3,500 a month, completely free of personal taxes. So moving on, I've got other slides. Scottish income tax, if you have anybody who has a home in Scotland, they have very different tax rates to us, much higher. So be aware of that. And also really just think about the reporting requirements. Self-assessment requires you to tell the revenue you've got tax to pay. They won't come and tell you. You have an obligation to tell them you need to file a tax return and deal with all these losses of allowances or additional tax rates. I'm aware of the timer ticking down on me, and with Jason over there might make me disappear in a green cloud of smoke. So I've got a number of other slides to rattle through. There's a lot of detail in them, so if you are affected by them, have a look at that in more detail. So the first is the non-domiciles in the UK. We saw some quite dramatic tax changes last budget that are now affecting those individuals. The predominant issue is people who have been resident here for 15 out of 20 years. They are now effectively treated like a UK taxpayer. So they are no longer able to benefit from keeping assets overseas. If you're somebody who might be affected by that, seek some further advice. And likewise, when we look at buy-to-let property investors, they're now in a period where interest rate changes are having a dramatic impact on their business returns. In particular, the restriction on interest, where they can only claim a 20% tax reclaim. Historically, you could claim tax at your marginal tax rate, so 40%, 45%, 60%. Now we're seeing a period where some or all of the interest is only deductible at 20%. Currently, we're in a period where there's a transition, but in a couple of years' time, buy-to-let investors will only be able to claim 20% tax relief for their interest. I've got some examples on the next slide, but to put that to life, I have a client who's got 10 properties. He's highly geared, so he's heavily invested, but we crunched his numbers and he found that although he was making a rental profit, once we looked at cash flow when these rules came fully into effect, he'd actually be in a negative cash flow situation because his tax liability will be higher than his income. Again, if you need advice on that, seek it from the team afterwards. There was one change announced yesterday in relation to property, which is renter room relief. People have been using this for the Airbnb type arrangement where they've let out their home while not using it. That's now no longer available, and you need to be in the house with the person occupying it at the same time to get renter room relief from April 19. The other changes, we haven't really seen anything dramatic, is capital gains tax. Now got a fairly stable period for the last 3 or 4 years. The capital gains tax annual exemption is increasing to 12,000 next year. But what we're seeing clients decide is perhaps to realise investments they may have held for a significant period of time that are having quite heavy taxable gains. With a low rate of capital gains tax we've currently got, now might be a time just to revisit things and remove some of those assets in your investments or your portfolio that might necessarily have a large part of your portfolio. So moving on, we've got other changes that were announced yesterday. Big surprise, principal private residence relief. From April 2020, the period where you can not occupy your home at the end of its ownership, in a bridging period, normally when you sell one and buy another, is now going to be cut to 9 months. That was 18 months. Only a few years ago, that was 36 months. For the divorce and family lawyers in the room, that's particularly important if somebody moves out of the family home. Equally, we were really surprised to see lettings relief change yesterday. That's an extension to the principal private residence relief that now will no longer apply if you're not in shared occupancy from April 2020. So if you've got a property that has been your home and it's now being let out, now might be the time to look at selling it and bank that existing relief before it's lost. Capital gains tax on residential property, we're also going to see people having to make payments on account. So currently you pay it 31st January after the end of the tax year. For non-residents, from April 19, they're going to have to pay that within 30 days. And for all UK taxpayers by 2020, they'll have to pay that capital gains tax within 30 days of the property sale. So it's key to get information available as quickly as possible. The other thing we've got is the government sort of targeting UK property. Inheritance tax is something that hasn't really changed dramatically over the last few years, but the one thing we do have is the residence nil rate band. Currently that stands at 125,000, but only a few years' time for a couple that would be 350,000. Complex legislation that the government are trying to introduce so that you don't get it, and in fact they made changes yesterday, quite technical changes, but it's something that if you're interested in claiming, you need to seek advice. The other change we had on inheritance tax is trust and the simplification of a definition of capital being added to another settlement. And the big surprise at the end of the budget was that the government spoke about changing the way and consulting the way trusts would be taxed to make them simpler, fairer and more transparent. Now, anybody who knows in taxes knows when they hear those words, that means generally tax is going to be higher rather than fairer or simpler. So it's a quick run through of a number of the tax changes that affected clients and business owners generally. Just some thoughts really to leave you with. There's multiple individual allowances to be claimed. Between a husband and wife, potentially there are 15 allowances that you can claim in addition to any investment allowances. Significant cliff edges means that if you drop over an income level, you're going to have a major marginal income tax rate. Think about self-assessment tax returns if you're not filing them, and look at the family business. Extracting money out of your business can be done tax efficiently. Changes over the last few years mean that might need to be revisited, and inheritance tax planning and the review of your will particularly important. So I'm now going to pass you over to Grant Buchanan, who's going to take you through some of the financial planning aspects.